And Malcolm Ethridge actually just bought the pullback, and Netflix added to the position. He joins us now. Malcolm, why Netflix today on this dip, and are you scared that there could be bigger dips to come in the coming months?
Hey, Dom. So we talked about this on the show yesterday, and the thing that I really liked about Netflix initially was the fact that, one, they've already gotten past that WBD distraction. They've finally sort of decoupled themselves from that, and that was initially the pressure on the shares. However, they've increased prices over the last 2 years, and they've also increased the paid subscribers by 40 to 50 million people over that same time. So we're seeing the street and the actual consumer going in two completely different directions. So to me, this is a chance to own a really great company that exists in a lot of people's lives and is not going away anytime soon, that has pricing power. They've shown us that because I just mentioned the price increases. And it's the ability to own it at about a 45 to 50% discount from its most recent highs. And so to me, the sell-off following the earnings, I completely get it. The Bears really wanted to hear something positive about the engagement numbers to make them change their mind, and instead they got the opposite. Netflix basically said, instead of telling you how bad our engagement numbers are in the near future, we're just going to eliminate that report and only tell you about it once a year, which is not what you want to hear. However, they did the same thing last year when they said they weren't going to tell us about their paid subscribers anymore, and the market seems to have forgotten about that metric altogether, and we can kind of estimate what it looks like. So to me, this looks like a great opportunity to be buying if you are a long-term minded investor, because this is not another semiconductor company that's going to be up 80% in a month. But it's an opportunity to own a really quality company that's basically a utility at this point for a very cheap price in comparison to what you'd have had to pay for it about a year ago.
All right, Malcolm Ethridge, thank you very much for joining us to give us the case for why you bought the dip. We appreciate it. Have a nice weekend, sir. All right, let's go to Kevin, because you actually earlier this week sold some of your position going into this earnings print. Why, and would you maybe take profits on that kind of position and then reposition for a higher on this particular pullback?
So we sold some on Tuesday, Dom, at 74. I wish we had sold it all. I like Malcolm's entry point here. I love the long-term thesis on the stock. But when it comes to streaming, content does matter. So let's just think about your friends and neighbors, Boys, Dutton Ranch, House of Dragon, The Bear. These are shows that people are watching. None of them are on Netflix. So for the time being, I think they need to straighten out the content if we're going to see the stock get back on the right trajectory. How can they do that? Well, I think live sports is the easy answer. So you think about NBC and what they own, the property in NFL football, NBA, the Olympics. Imagine if Netflix was to pivot and own those properties. Now you've got something where the eyeballs are not only going to be there, but they're going to stay there. Nothing draws the viewer like Monday Night Football. Imagine if that was on Netflix.
I mean, they're kind of already putting that marker out there, right? So
I exited the rest of my position earlier in the week. And the reason why I did it, and I mentioned that, look, I could be wrong with a quarter, because you typically have quarters where they bounce back after a bad quarter. I would just, frankly, edit what Malcolm said, which is that this is where he said this is a good time to buy it. This is another good time to buy it, because it's continued to miss. And the issue is, and they said this very clearly, we're worried about growth. That was my concern. It remains my concern. Competitive landscape has been enhanced quite a bit. I think that, if Malcolm wants to park money, there are other places to park it. I think this is dead money for at least the rest of the year and maybe longer. Now, if they do try to engage in a bidding war for sports, good sports, that's going to limit their ability to, number one, give back money to shareholders and to get other content. And to see other content, not the sports that people could sign up with for a trial, 1 day or 1 week trial. It's the constant contact that you're streaming repeatedly, the 10-episode series and so forth, that keeps viewers engaged. So I think it's dead money. Yes, it's a great business, solid business. Yes, it's utility, but you don't get paid like utility, as Jenny will tell you.
Yeah.
So I just don't see any point in buying it here.
What do you think, Jenny?
I don't think it's utility. And I think what Steve said the competitive landscape has been enhanced. I think that's a very kind, very gentle phrasing of what's gone on. I would say the competitive threat is dramatically increased versus any time in Netflix's history. So today, content can be created more cheaply, more easily, more robustly, thanks to the amazing AI generation tools behind it. And that is a significant competitive threat to Netflix. It's trading at about 18, 19 times, right? Markets at about 20 times. It should have a bigger discount to the market because this thing's under threat. Like, however you cut it, it's under threat. Unlike Disney, where Disney, and I hate going into Netflix Disney, so I really don't want to drag there, but just Disney's content, for example, is more of a library. They're not totally dependent from a content perspective on creating new content. Netflix is much more dependent on new content creation. So they're competing in a very competitive space already. And then in the worst part of that, I think, which is new content creation, is what drives viewers. Everywhere I go, even sitting on the desk sometimes, people are like, oh, I stopped, I cut off my Netflix. I'm just not using it. I'm just not watching it. There's so many other places to go for interesting things to watch. So I think it deserves a multiple, I don't know, of like 15 times or 14 times, but it deserves a discounted multiple. That's where I might ever consider it again, but still with roughly a market multiple, at best it's dead money.
There are some folks who believe that that higher multiple could be commanded if they get the capital budgeting correct between the pivot between content, movies, and studios versus that live sports component and what the ROI is on investing in both of those vis-a-vis your AI creation and everything else. So that's going to be something.
That's a completely different analysis than is subscription growth accelerating. They've got very, very low churn. Churn's almost, 2.5% is negligible. But where's the growth come from? You see, their issue is that they've had to shortchange the American consumer where it started in terms of viewing to go global, right? So they have to dilute their budget globally, and you may not have the same growth over there as you have here.